Hi, Deb Jones here, board member of CapitalW Collective. Welcome everyone to the third segment of CapitalW Collective's Pricing Fundamentals series, in which we've explored mortgage pricing. Our first two videos, the basics and the recipe, described the mechanics of the capital markets and the components of mortgage rate and price quotes. As we discussed in those videos, one of the most important aspects of creating a mortgage quote for a borrower is the value a lender ascribes to the mortgage servicing right, or MSR. To dive deeper into the factors that influence MSR valuations, we've asked our friends and experts at MCT to share some fundamentals of MSR pricing with our CapitalW Collective community. If you're just learning about CapitalW Collective, we are a nonprofit providing an environment of learning, growth, recognition, and achievement in capital markets within the mortgage industry, and we're free. We're excited to have the experts at MCT round out our Pricing Fundamentals series to discuss the important and complex MSR components of interest rate pricing. If you're new to CapitalW's Pricing Fundamentals series, we encourage you to watch the first two videos, the basics and the recipe, for a holistic understanding of mortgage rate pricing. Presenting on behalf of MCT today is Natalie Martinez. Natalie joined the MCT Lock Desk Division in 2015, and in 2017 she moved into the MSR division in her current position as the manager of the MSR Services Department and Client Success. She oversees portfolio valuations, refines the MSR department's flagship model, MSR Live, and optimizes the user's experience. We're very excited for the MSR knowledge that Natalie is about to drop on us, but first, let's run through the agenda. First, I'm going to cover a quick recap of the Pricing Fundamentals session for a refresher. Then I'll turn it over to Natalie, who'll help you define mortgage servicing rights, understand the advantages and disadvantages of MSR assets, discover the accounting approaches to MSR, and learn the difference between fair market and economic values of MSRs. She'll help you discern key valuation drivers and continuity and valuation, and finally provide current market insights into MSRs. To prepare to go deeper into mortgage servicing rights and their valuation, let's first have a quick refresher on pricing from our previous videos, the basics and the recipe. You might recall the slide. As lenders invest their capital into mortgage assets, some may choose to retain or purchase whole loans or securities. Some may choose to retain or purchase servicing. Some may sell servicing, and some may do any combination of these strategies at the same time or during different market cycles. Recall that MSRs are only created in a securitized sales structure in which the loan and servicing are bifurcated into two separate assets. An MSR can be separated into base and excess servicing, each with its own valuation methodology. Lastly, let's run through some of the secondary marketing terminology related to mortgage servicing rights. On the slide, the refresher here is about the components of the base and excess, the base being the fee earned by a servicer for administering a loan for an investor, and the excess is the portion of this servicing that exceeds the standard compensation of servicing. Your execution types are released and retained, released being selling the servicing asset to another entity, and retained, what I want you to think about is that the servicing may be retained despite the sale of the loan. And a refresher on the expressions, the MSR, the mortgage servicing rights are the contractual rights to service the mortgage loans, which include collecting the mortgage payments, managing the escrow accounts, and default-related issues. Whereas this SRP, the servicing release premium, is the fee that the lender receives when they sell the servicing rights. And last but not least, the multiples. That's the factor used to value the present worth of the base and/or the excess servicing income, and that is used in price analysis. Natalie, thanks so much for sharing your knowledge with us. And with that grounding, I'm going to turn it over to you to share your expertise and go deeper on the factors influencing MSRs and mortgage rate pricing. So Natalie, take it away.
Thanks, Deb. I'm so glad to be here with the CapitalW Collective and its community of learners. So I've been with MCT for over 10 years now, and in the MSR space for about 8. So I'm very excited to go over some of the fundamentals of MSRs. All right, so to begin, what is an MSR? MSR stands for mortgage servicing rights, and they're simply the right to service a mortgage, which includes the responsibilities of collecting the borrower payments, customer service, and loss mitigation, just to name a few. And in exchange for servicing a loan, a servicing fee is collected. So for Fannie and Freddie, the standard servicing fee is 25 basis points. That can go up to 50 basis points. And for Ginnie Mae, it ranges from 19 to 69 as the standard. So MSRs are created when loans are sold into the secondary market, generally when loans are sold to Fannie, Freddie, or Ginnie. At that point, the servicing asset becomes a distinct asset and is separated from the whole loan. And these MSRs have a distinct value and liability as they generate cash flows distinct from the mortgage itself. And while the servicing asset and associated cash flows are technically and legally owned by Fannie, Freddie, or Ginnie, the servicers are still able to benefit from the cash flows that come from servicing the loan. And if any entities don't have the infrastructure to service loans themselves, which can be quite extensive, they can contract out third-party approved servicers to perform the required functions called subservicers. So these servicing costs, are just one of the costs that come with owning MSRs, but we'll get more into that in the coming slides. Next, I want to go over some of the advantages and disadvantages of owning MSRs. So just like with any asset, there's pros and cons, advantages and disadvantages to owning MSRs. However, we tend to see that there's more reward than risk when it comes to MSRs, and that's why we've been seeing a trend of more and more companies owning them over the recent years. So one of the advantages for owning MSRs is the minute you start owning that MSR, it's generating positive cash flows, predominantly coming from that servicing fee income. Additionally, you might have heard of MSRs as being a natural cross-hedge to production, where the servicing income and positive cash flows generated from the servicing asset can be used to offset, any risk from an economic downturn or production downturn. So in a production downturn, companies can use that cash flow income to help sustain the business and help retain staff. So when the cycle returns of higher production, they can easily transition into production again. And again, you can even think of it as an annuity income where the asset is generating revenue regularly. But it also gives you an alternative secondary execution. So for example, if you originate a loan and you can't sell it to an aggregator, you're not going to have to sell it at a loss or a low value. It gives you that optionality to capitalize on those loans. And finally, last but not least, it's also the ability to increase the franchise value. The company's value itself will increase because that balance sheet is increasing. Now for some of the disadvantages, the operation itself can be quite cash intensive, but it does depend on how you manage that business. Whether you service the loans in-house, or use a subservicer, that will dictate how much cash you're going to give up. And obviously staffing also depends on whether or not you use a subservicer. It's also resource intensive. It requires a lot of monitoring, compliance, and reporting. There are also some cash advance risks and responsibilities, which we'll go into more detail later. Loss mitigation responsibilities as well. You have to work with the borrower, with agencies to make sure that everything is filed and, following the rules that the agencies and regulators have set out. There's also some compliance related to Basel III and CFPB regulations. All of these things have to be considered. And then aside from that, there's, also potential legal exposure, whether it's company related or borrower related, if the borrower filed for bankruptcy or there's some other legal risk that you have to deal with. So all of these can add to the overall cost of the operation, but overall it's still manageable, and depending on the operation and the business strategy, you can mitigate those expenses and risks and have a profitable business. So, before we go any further, I really did want to go over the three main types of valuations or MSR values that are commonly used, as these definitions will continue to come up. And, when we talk about different valuation types, we're really talking about the different assumptions being utilized for that valuation. What assumptions are used in the valuation model to come up with the value. So to start off with, we have market values. So as the name suggests, this valuation uses current market assumptions. They're the assumptions we use when we're brokering a bulk sale, for example. And because these assumptions can vary greatly depending on the current bulk market, they can be quite volatile. Next up is fair value. So this is the value used for accounting purposes, and these are the third-party valuations we would typically provide to clients. So when MSR bulk sales are actively trading, fair value is actually fairly in line with market value, at least the trends quite similarly. However, when the market's not active, we have to make assumptions and provide valuations as if it were an active market, because fair value analysis is not entirely dependent on the current bulk market. So for fair value assumptions, in addition to understanding where the current market values and assumptions are, it's also important to be in line with the rest of the industry's fair value assumptions. And one way to do that is through quarterly broker surveys in order to ensure your assumptions are in line with the rest of the industry. So all that is to say, fair value assumptions do not change as often and are not dictated by the current market. Another common valuation is the economic value. So this is where a company takes their actual servicing costs, or what they're being charged for their subservicer, their earning and advance rates, yields, just to name a few, and enter those assumptions into the valuation model. This is going to produce cash flows that accurately reflect the company's true advances, what they're earning on their float earning, servicing costs, how much those are. And these are crucial for clients to get a better understanding of their actual cash flows and position. And on this next slide, to really illustrate the difference between fair value and market value, we can see the impact the pandemic had on these values. So before the pandemic, you can see the green line, that fair value, is trending right below the red line, which are the SRP or market levels. However, in March 2020, you can see that dramatic drop in the SRP values that started the pandemic. And while you do see a fair value drop as well, again, it's not nearly as volatile as the market value. And again, this is because fair value is not solely based on current market values. And on this next slide, it really highlights the volatility of the retained versus release market in general. So this graph depicts the percentage of committed loans going retained, so selling to Fannie, Freddie, or Ginnie, and retaining the servicing, versus going release, or selling to the aggregators. And this is for all MCD clients from October 2024 to current. And as you can see, while currently there seems to be more of an even split, historically we can see percentages going from an 80-20 split versus 60-40 split. So this really just signifies the importance of knowing where these levels are because of how quickly the market changes. You want to ensure you're keeping up with current market values, to ensure you're truly best exiting these loans going retain versus release. And that's something we help with our clients with. So next, let's get into the different accounting methods for MSRs. So there's really, two types of accounting methods: low-com, or lower of cost or market, and fair value. So for low-com method is the more conservative accounting approach. It focuses on potential losses rather than recognized gains, which can be beneficial in maintaining a conservative financial position. And because it's predictable and it's more stable approach, this method is often recommended for those just starting off with retaining MSRs. It's also often easier to implement and maintain and requires fewer resources to manage. So by not adjusting the value of the MSRs upward to reflect current market values, those using low-com method can avoid unnecessary volatility and the effects of temporary market fluctuations, which might not accurately represent the long-term value of the asset. Low-com is also a more measured approach and has to include amortization in the analysis as well as consider impairment. But as clients grow, we do often see them tend to make the switch to fair value. So what is the fair value approach? Fair value, like the title says, you're receiving a fair value analysis from a third party and using that value to book your asset, which ultimately can achieve higher balance sheet valuations. However, because fair value can change from month to month, even if the portfolio is staying the same, just due to market volatility alone, you will experience volatility on the valuation of the portfolio. So why do people switch to fair value? Fair value accounting is considered the more dynamic approach and does provide a more accurate reflection of the current market conditions. Fair value accounting also makes it easier to compare financial statements across the industry. It's providing enhanced transparency on the value of the MSR portfolio, which is why as clients grow their MSRs, they might want to make the switch to fair value accounting as it aligns with regulatory requirements or what's considered, industry best practices. And one final thing to note here is that, once you choose the fair value accounting method, you are locked in and can't switch to low-com. So now that we've talked about the different valuation types, let's get into why MSR valuations are necessary. And really, I should say why regular MSR valuations are necessary. And ultimately, I would say they're important because you don't want to be blindsided when auditors say it's time to get an MSR valuation, which, as we discussed earlier, would be a fair value analysis of the MSR portfolio. So it doesn't have to be monthly, especially if you're just starting out. Quarterly is definitely sufficient, or even semi-annual, but we really recommend semi-annual as a minimum. And that's just because anything can happen during the year. And unfortunately, we've seen that take place with clients who've opted for only annual or biannual evaluations, where their value shifted significantly, causing big write-downs and a shock to their P&L and balance sheet. So definitely pays to have a regular third-party valuation. Additionally, you will ensure all of the regulatory or auditory compliances are met, and at the same time, again, it eliminates any balance sheet and P&L surprises that could impact the company's financials. Also, when you're receiving these regular valuations, it helps you understand not only the direction of the value, but also the levels of profitability and the value of the asset itself. So now let's get into some of the key drivers of an MSR valuation. There are a number of factors that affect the value of the MSRs. To start, we have different investor types and the various remittance types. So for the remittance types, we have actual, scheduled actual, and scheduled. And these directly influence the value of the mortgage servicing rights due to the differing cash flow patterns and risk profiles associated with each. So to start with actual, this is associated with the Fannie Mae investor. And this remittance type, the servicer remits the actual principal and the actual interest payments received from the borrower. So if a borrower makes a late payment or defaults, the servicer only forwards what's been collected. So actual has lower operational and financial risk for servicers since they do not need to advance their own funds for missed payments. This ultimately reduces the financial risks and costs of servicing, potentially increasing the value of the MSRs. However, since cash flows are less predictable, there can be a discounted value due to that uncertainty. And before I go on to the other remittance types, I do want to note that regardless of the remittance type, the servicer is also always going to be required to advance any shortages on the borrower's escrow accounts or any delinquent tax or insurance payment for borrowers who are not escrowed. Okay. So moving on. So for scheduled actual, this is associated with the Freddie Mac investor. The servicer is required to remit the scheduled interest and the actual principal payments to Freddie. So if the borrower defaults on the payments, the servicer still must remit the scheduled interest payment, meaning they must make advances for the interest, but they're not required to remit the principal amount. Scheduled actual introduces more risks for the servicers compared to actual, because again of the obligations to advance funds, thus increasing liquidity requirements and potential costs if delinquencies rise. This higher risk can lead to a lower valuation of MSRs due to the cost and financial strain associated with advancing payments. However, there is a potential for higher earnings as well. Servicers can gain money on the number of days the interest payments are held before being remitted to Freddie under a scheduled actual remittance. So when a servicer collects payments from a borrower but holds them for a certain number of days before remitting to investors, the servicer can actually deposit those funds into an interest-bearing accounts. These interest earned during this period is called float income. And the longer the funds are held, the more income that servicer can generate. And this predictable cash flow income can lead to higher valuation of the MSRs. So next we have scheduled, and this is tied to the Fannie and Ginnie Mae MBS investors. So under this arrangement, the servicer remits the scheduled principal and interest payments to the investors, regardless of whether the payments are received from the borrower. Meaning the servicer must ensure the full payment is made on time, regardless of delays or defaults by the borrower. So scheduled schedule therefore provides the most predictable cash flows, which can be attractive and command a premium. However, the burden on the servicer is highest under scheduled schedule. This high level of responsibility and risk can increase servicing costs and require more capital reserves, potentially decreasing the MSR value. But next we have state. So there's a number of factors on why state might cause different MSR values. For one, we monitor prepay speeds based on state. We do see that the prepayment speeds can differ greatly from state to state. Foreclosure timelines also vary greatly from state to state. And the longer the foreclosure timelines, the lower the value of the MSR. Average UPB for a given state is another major driver, as higher UPBs can increase the value of the MSRs. And finally, the economy of the estate and the home prices, is another driver. For coupon, so if the current market rates are higher than the interest rate of a loan, that loan is considered, or what we call, in the money, as the likelihood of a refinance is lower and the value of the MSR is higher. So, in other words, as mortgage rates increase, prepayments will decline, therefore the MSR value will increase. Alternatively, a loan is considered out of the money when the current market rate is lower than the interest rate of the loan. There is a higher likelihood the loan will refinance and the value of the MSR is lower. So when mortgage rates start to decline, prepayments start to increase and the MSR values will decrease. So on to the next slide, some of the other core variables that impact the MSR value is the loan to value. So the higher the LTV, that means the higher monthly payment because the borrower did not put enough of a down payment. And higher monthly payments could expose the loan to potential delinquency. And the opposite of that, a lower LTV, meaning lower payment, there's less delinquency potential. However, we've seen lower LTV loans could also mean faster prepayment because those borrowers tend to have higher credit scores and tend to refinance quicker. So there tends to be this push-pull with a lot of these key drivers of the MSR value. Very similarly with FICO scores. They can impact delinquency and prepayment behavior, where high credit score means that generally there's a lower chance of delinquency, but at the same time, those borrowers could easily refinance for the slightest change in an interest rate. Lower scores, tend to have longer duration because those borrowers tend to stay put. However, again, they could end up with higher delinquencies as well. So again, that push-pull. For earning rates, one of the leading valuing components of the entire MSR is actually the escrow earnings. It's second only to the servicing fee income. And as I briefly mentioned earlier, while servicers are required to advance any shortages on the borrower's escrow accounts or any delinquent tax or insurance payments for borrowers who are not escrowed, they are still able to make flow income while these payments sit in an escrow account. And depending on your banking relation, you can earn some interest on these accounts. And the flow income makes up about 20 to 30% of an entire MSR value. And in terms of interest rate on advances, as we talked with the remittance type, servicers are required to make advances on various payments depending on the remit type. So the servicer will have to advance shortfalls until it be collected back from the borrower. And in most cases, the servicer will have to borrow and pay interest on those borrowings to cover those shortfalls. So ultimately, this adds to the cost of the servicing. So we have a few more key drivers here. Next up, we have prepayments. So it really is one of the most critical components of valuing an MSR. And it's really the biggest driver to any MSR value. And that volatility depends on many factors. The interest rate environment we're in, the economy, geography, home prices, all of these different factors will dictate how borrowers will behave in terms of prepayment. For discount rate, this is essentially the risk measure for that asset you're holding. So for Fannie and Freddie, those are lower risk because the credit requirement is very strict. Therefore, the risk of default or risk of prepayment is lower. So we could use a discount rate somewhere between 9 to 10%. Currently, it's around 9.5% for fair value. And for Ginnie, on the other hand, there's more delinquency risk than agency loans. Therefore, we would use a discount rate somewhere between the 10.5 to 12.5 range, depending on the portfolio size and the originator. For Ginnie Mae, currently we're seeing somewhere close to 12%. And for average UPB, with UPB, the higher it is, the higher the servicing fee income. However, there's also a higher prepayment risk or higher default risk because of the higher monthly payment the borrower will need to make. So again, with a lot of these different drivers, there are pros and cons to both ends. And with MSRs, it's really about finding that balance between, the risk and rewards of these different loan characteristics. And as we talked about the different factors that affect MSR values and the volatility around these values, now I want to get into the importance of having, not only granular MSR values, but also a value continuity throughout the life of the loan. So one area we see those, new in the MSR space struggle with is really how to handle and manage this asset appropriately, especially when it comes to what levels to book their MSR asset at initially. Because when it comes time to get an official MSR valuation, they may end up with, a lower value on their valuation and have to write down the MSR portfolio. This can happen, for example, if the company is using SRP or market levels to book their loans. And as we've seen in the chart showing that the SRP versus fair value levels, depending on the SRP or market values, they can vary greatly from fair value levels. And this difference comes for a number of reasons. One, the aggregators may be including recapture strategy in their values, or they have a business objective to retain a certain amount. They may want to maintain their MSR portfolio from UPB runoff, or their current strategy is to just grow their portfolio as much as possible. And these strategies are not going to be reflected in fair value levels. So in order to stabilize values, we really recommend having consistent valuation assumptions for the life of the loan. And as I mentioned earlier, a typical, third-party valuation would be using fair value assumptions, meaning in the beginning, when it comes to that, initial pricing or that rate street pricing, we would really suggest using MSR pricing grids or loan level values that are using fair value assumptions. And, not only is it critical to have these assumptions line up, but it's also imperative to have granular values as well. So, one other mistake we often see are companies that are using flat rates, to price all of their loans. However, as we've gone over today, there are many loan level characteristics that affect the pricing. So in order to have these consistent values, it's really important to have, or really to be as granular as possible, whether that's on a grid level or in best case scenario, loan level. So if you are using, fair value assumptions from initial pricing to when you're committing the loan, to getting a valuation, then really the only changes to the valuation should be, any market movement. And that would really minimize the volatility of the MSR value from initial pricing to valuation, and again, minimize any impairment risk. So to close out, I want to reiterate a few key takeaways from MSR 101. So number one, the MSR asset contributes to building franchise value. And it's certainly important to understand the advantages and disadvantages of MSRs, but ultimately it is a valuable asset. MSRs are providing immediate cash flows and long-term value. Secondly, optionality is critical. It gives you the ability to pivot depending on market conditions, and that flexibility can really make or break a company in different market scenarios. MSR is also a natural cross-hedge, relative to production revenue. So as production is declining and revenue shrinking, the value of that MSR asset is climbing. And it's not an all or nothing scenario as depicted in, the retain release graph. Most companies have a retain release split. So it really just depends on your strategic objective. And finally, strategic management, accurate valuations and the right accounting practices are all essential for leveraging MSRs to maintain profitability and competitive edge in a volatile market. So with that, that wraps up the Pricing Fundamentals MSR 101 session. And if you have any questions, please reach out to me. My email address is here on this slide. I'd also like to note that, MCT has the resources, expertise, and technology to support your strategic objectives. So we'd love to hear from you. And I encourage you all to visit the MCT website on this slide as well to learn more about all things capital markets. And, be sure to sign up to be notified of webinars, new publications, studies, reports, and other thought leadership items. I hope you picked up a few things during the session, so thank you all for joining us, and I hope you all keep learning. And with that, I will pass it back on to Deb. Thank you, Deb.
Thanks, Natalie. Great information. And I know our CapitalW Collective community will benefit from these knowledge nuggets in their mortgage capital markets journey. And as Natalie said, if you have questions, don't hesitate to reach out to her, and be sure to visit MCT's Learning Center at their website. Of course, you can contact CapitalW at our email address with questions and visit us on our website. Finally, we invite you to follow both MCT and CapitalW Collective on LinkedIn to keep up to date on future educational offerings. Remember, they're free. And as always, we're glad you're here to educate, elevate, and empower yourself and others through the sharing of mortgage capital markets information. Thanks, and see you soon.